The first month of 2025 is already behind us, which is a crazy thing to say because I remember making a video talking about January at the end of 2024. Time goes by extremely quickly. I have no idea what's going on. But anyways, we've started off the year, I think, quite okay, right? If we look at the Nasdaq, S&P, Dow Jones, Russell 2000, it's fine. As Tom Lee predicted, actually, the Dow Jones right now, industrials are outperforming, up 5.52%. S&P up 3.8, Nasdaq 3.6, and Russell 2000 is up 3.5%. Interestingly enough, if we add the German and the French markets, those have outperformed the American ones at the moment. Germany is up 9.5%, France is up 8.2%. Thank God I made a video about European stocks at the end of 2024. So in this video, as always, let's touch on 4 stocks, and without wasting any more of your time, these are the stocks. And as always, I do hope you keep watching, and if not, leave a like and a comment, would really appreciate that. And of course, subscribe if you're new here. And yes, I know I could have added way more companies to that list, other companies as well. But since we are in the earnings season, I don't want to touch on the companies that are yet to report earnings, right? The AMDs, the Ubers, the Alphabets and all of that. They will all report earnings actually, I think, next week or in the next 2 weeks. So I'm keeping those companies a little bit on the sidelines for this video because I do expect some volatility. Now, before continuing, if you enjoy this type of videos, leave it a thumbs up, subscribe. If you have not, we really appreciate that. If you want to support me even further, do check out the link down in the description. Any other pinned comment, get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. And by the way, I know the names in this video might not be the most interesting one or attention-grabbing one, but I do think that those are interesting companies to look at. Of course, SoFi, we've been talking about SoFi for quite a while, but I had to put it in the list. It reported earnings. I think the market overreacted. As always, I think investors overreact as always. So let's start with company number 1. And that might maybe be the most boring name on that list, and that's Canadian National Railway Company. It has a market cap of $66.72 billion. You can buy it in the US, you can buy it in Canada as well. It pays a good dividend, has a dividend yield of 2.32% and a forward PE of 19.1 times. At the time of making this video, the average analyst price target sits 13.13% higher than the price we're at today. Looking at some pricing metrics, we can see that we are below the 10-year mean when it comes to forward PE, a bit below, not by much. EV to EBITDA is a bit above that. Price to sales is below. Price to free cash flow, that's the only one here in the last 12 months. That's a bit of the same. And by the way, you can see that during the pandemic period, that's when this got a higher pricing multiple. The business was struggling, supply chain issues and all of that. So you have to take that into consideration as well. Now, if we look at what's expected from the business in the next coming fiscal years, revenue growth, not the huge growth, but steady growth for revenue. As for free cash flow is expected to be down to flat-ish for fiscal 2025, then grow 7.6% in fiscal 26, and then another 8.8% in fiscal 2027. Now, zooming out a little bit and focusing purely here on free cash flow and free cash flow margin, it does seem like free cash flow margin did peak right here at the end of 21, beginning of 2022. Made all our way back down to around 21% right now. There were also some supply chain issues which affected the company, but they do say that things are looking much better right now. Now, if we look at the return to shareholder, if we look at shares outstanding, in the last 10 years, shares outstanding went down by 22.3%. That's a reduction of 2.6% on a compound annual growth rate. If you look at the dividend yield, we're actually close to the, highest it has been previously. So I think you're getting a good deal here of a good, solid compounding company. They also said that over 85% of traffic originates on Canadian National's network and over 65% originates and terminates on Canadian National networks. We can see the percentage here on the screen. They do have a diversified portfolio. 19% comes from petroleum and chemicals, 19% from grain and fertilizers, 12% from forest products, then you have 12% from metals and minerals, 14% international intermodal, then you've got the others right here. Now, like I said, this is not your most exciting business, but if you're looking for something that is not tech related, still growing steadily, returning value to shareholders by acquiring more shares and paying a dividend, I think this one could be it. Moving on to stock number 2, completely different profile here, higher risk, higher reward, and that's Moderna. Moderna right now has a market cap of $15.8 billion. In the last 3 years, this stock has been completely obliterated, down 74%. Of course, the stock skyrocketed during the pandemic because that's also when it made a ton of money and profits. Right now, that's not the case anymore. But I'll try and make the case why I think that around these types of prices right now, risk reward makes a lot of sense. First of all, if you look at price to book at 1.3 times, I mean, that's quite cheap. Yes, it's true that in the next fiscal year, revenue is still expected to go down 31.7%. In fiscal 26, the estimates here are still at $3 billion. Yeah, could be a little bit more than that, but that's when things start to accelerate. Looking at the average analyst price target, that sits 53.4% higher than the price we're at right now. Now, we can look at pricing metrics, but then again, if there are no earnings, then there is really not that much to focus on right now. So let me just show you what has happened with Moderna in the last couple of years. Well, you can clearly see what has happened during the pandemic, right? Everything went up. Gross profit, total revenue, gross profit margin, all of that exploded. But afterwards, they even admit they made a miscalculation, because look at what happened next. Revenue completely disappeared. The profitability profile of the company went out of the window. But more recently, we are seeing things improve. All in all, how do they generate revenue? Well, the majority comes from product sales, then you've got grant revenue and a tiny bit of collaboration revenue. But yeah, the full focus obviously is on products. And this is the thing, buying Moderna today is basically betting on the fact that their next 10 product launches, which you can see right here, up until 2028 are going to be on time, successful, no regulatory issues. Yes, I know there are some risks right now because, well, RFK is anti-vaccine, even though he said he's not anti-vaccine, but there is the whole media play here. So yes, you have to take all of that into consideration. But this is basically buying Moderna today, you're buying this portfolio right here. They also said the following with regards to profitability, cash burn, and that 2028 target. I think what the market is missing is that we are overly concerned about cash burn and not giving us credit for like what that investment, we like to think about it as an investment, may bring to the top line. The investment meaning all of these new products. So they've laid out for everyone, there's 10 products that are potentially coming to market between next year through 2028. If you consider COVID a stable market, and this year they're going to do $3 to $3.5 billion in revenue, give us a haircut, and that's about $2 billion in revenue, recurrent revenue stream for them, then you're looking at an incremental $4 billion in revenue to the top line by 2028. So the goal here is basically around $6 billion by 2028 and break even at that point. Moderna is also partnering up, working with Merck for a skin cancer vaccine, and that has shown survival benefit in long-term follow-up. And well, if that product becomes successful, that's of course a giant revenue stream for Moderna, and not just money-wise, right? We're talking here about solutions that can save people's lives. And you might or might not have heard, but there is this thing called artificial intelligence, and all of these companies investing billions and billions in training compute and all of that. That could definitely help, well, gene sequencing, discovery of new vaccines, new treatments, and Moderna being basically a platform which will work with plenty of those players could be a big winner because of that. Of course, higher risk, higher reward. Moving on to the next one, and that's the huge powerhouse coming out of France, luxury business. So LVMH has a market cap of $363.9 billion and a forward PE of 24.8 times. The luxury business has struggled more recently, that's no surprise. Hermès has actually performed better than LVMH. Hermès is just in a league of their own, but LVMH stock is down 13%, let's call it, year on year. In the last 3 years, it's down 8%, and in the last 5 years, still up 65%. This company is not expected to grow double digits, but its bottom line is. Right now, the average analyst price target sits just 4.6%, 4.7% higher than the price we're at right now. Looking at some pricing metrics, we can see that all of them are still a little bit below the 5-year mean, not by much. And then looking at free cash flow growth, we can see that in fiscal 25, that's expected to be flat-ish, But then it's expected to grow faster than revenue in fiscal 26 and fiscal 27, 8 and 8.7% respectively. LVMH generates revenue through, well, wine and spirits, fashion and leather goods, which is the largest segment, perfume and cosmetics, watches and jewelry, and selective retailing revenue. And this was basically last quarter's figures right here, which they reported not so long ago. And then looking overall 24 to 23, well, it's down a little bit. Perfume and cosmetics actually did a little bit better, and so did selective retailing. We can see right here that France makes up 8% of revenue, Europe excluding France 17, United States 25, Japan 9, Asia excluding Japan 28, and then the other markets 13. With regards to revenue by business group, wine and spirits 7%, fashion and leather goods almost 50%, sitting here at 48%, perfume and cosmetics 10%, watches and jewelry at 12%, and then selective retailing at 23%. This is a business, a luxury retail business with operating margins sitting at 23.1%. The reason why I'm putting this on the list right now and not when things are at all-time highs is because, well, you would rather start buying these types of companies for the long run when sentiment is not that great. Because I truly believe that a company like LVMH is really not going anywhere anytime soon. There will be those down cycles, especially, well, because China is quite important to them for the luxury market, not just for LVMH. But even in a down cycle, this company is still performing better than most of its peers, excluding Hermes. Moving on to the last one, pretty known company here on the channel, and that's SoFi. I did a full SoFi video already after the earnings report. I'll do a follow-up, but here is already the reason why I'm putting it on that list. It's quite simple, really. In the last 5 days, stock is down around 10% because of the earnings report. But if we zoom out a little bit, year on year, the stock is up 92%. In the last 3 years, the stock is now still up 45%, has a market cap of $17.68 billion. This is a company that has a bank. Now, if we look at the expected growth rates, top and bottom line, in my opinion, still conservative, especially if we look at that fiscal 2026 EPS expected number from analysts, only 46 cents, whereas we know that management reiterated that 55 to 80 cents 2026 guidance, and they also said that EPS target is nearly 40% ahead of consensus for 2026. So yeah, I mean, overall, the quarter was a good one. I think the majority of the concerns here came because of guidance. Because if we look at guidance, they only expect 27 cents diluted EPS for the year. But again, this was the concern. This was the question that we had. What about that 2026 EPS number? It's reaffirmed, so I'm really not that worried anymore. Plus, they also reiterated the 20 to 25% EPS compounding growth expectation beyond 2026. Also, one extra thing here with regards to EPS for this year, it's also because of a higher tax rate. Before I forget, the average analyst price target does sit over 17% lower than the price we're at right now. All in all, the quarter was a good one. Yes, the tech platform is still the disappointing part of the thesis right now. We don't really get that much information with regards to that side of the business. That's still quite disappointing. I can be a bull and say that this is still disappointing, but all the other segments are still growing quite nicely, especially the financial services side of things. The CFO also announced a $5 billion loan platform business contract during the call. We know that when we talk about loan platform fees, fee-based revenues, that's usually super high margin for them. So I'm really happy to see that they're focusing on that quite a lot. The more that this segment of the business is growing, well, the more profitable the overall business will become. So if the market gives us opportunity to buy more, right, if we do go another 10-20% lower than the price we're at right now, so be it. To me, it's very important. If management, any other company, doesn't matter, is giving us a medium-term guidance, and that guidance is still reaffirmed each and every time, who am I to complain? So that's why it is here on the list. You don't have to buy it right now. I think there will be opportunities when we're going to see these deep seek types of Mondays when there is a super big overreaction, but let's face it, nothing really changes that much in a negative way for the majority of the companies. So all in all, that's about it. Do let me know what you think down in the comment section below. Like, subscribe, all of that, and I'll see you all in the next one. Bye bye.